Stephen Davies, Founder and Chief Executive Officer at Javelin Wealth Management, joining in, as is Jonathan Barratt, Chief Investment Officer at ETO Markets. Welcome to both of you. Always a pleasure. Stephen, let me come to you first. The pause on expected lines, but would you be too worried with the predictions for GDP growth as well as inflation that have come out from the Fed, both not quite as pretty?
The natural effect of any tariff increases will be to obviously both increase inflation and to reduce growth. So it seems quite likely that the Federal Reserve is beginning to bake at least some of that into their cake for the future. When we start looking at this word transitory, it was interesting listening to Chairman Powell. I think that he's qualifying his statement by saying so long as it works relatively quickly through the system. What we've learned so far is that the US will do what it does, other countries will retaliate. So this actually could go on for rather longer than expected. So that's a bit more difficult to quantify in terms of the effects both on interest rate policy and therefore growth and inflation too.
An interesting point that you make. I want to know what Jonathan thinks about that as well. Because when you listen to the statement, of course, when you read the headlines, you see that the word transitory is back. And do you buy into it? Wall Street certainly seems to have taken it as it comes. Jonathan, what do you make of that? Because he has put certain conditionalities to it. He said if it passes through relatively quickly.
Look, I think it's transitory is a nice word, but it also suggests to me that he's taking a bit of a punt, saying that he think it might pass through or it might not pass through. But I think at the end of the day, when you look at the dot plots, and there's only 4 of them, I think over time, you'll see more of them actually say that I don't think we will get a rate cut. Because I think it's been proven historically that when you do impose these tariffs and they keep going and we get that volatility, it does sort of push through inflation. So I think the transitory message is just it's something that needs a lot more time, but I don't think you can look through it when the hard facts say it will be inflationary. So I'm out there basically saying I don't think the Fed will be that aggressive on 2 more rate cuts this year.
Jonathan, here's the question then. Is it going to be 2 or could it be more than 2 if indeed things are not so bad on the inflation front, even though there is a warning? So it's maximum 2 according to you, right?
Yeah. No, I don't think we'll actually get up to that 2. I'm actually of the view that that transitory period will actually say the Fed will come out and say, well, hang on, we're getting that inflation coming through. Well, I'm going to hold back, and this could go on, to the end of Q1, Q2, Q3, and then you're running out of time to actually do the rate cuts. So when I do look at it, I do think that the inflationary aspects, that chance of stagflation is high. But on the other hand, remember the Fed also said he's reducing quantitative tightening. That's coming right back in again. So on one hand, he's going to keep rates, but he's also going to reduce the amount of tightening that they've been doing over the last couple of years.
Okay. So the main question that I had was, and maybe Stephen, you can come in on this. If you concur with Jonathan that it's maximum 2, maybe less, what have you, and it's a moving part, what happens to the other key central banks? Because I think a clutch of central banks have started on a rate cut drive. If the Fed doesn't cut, can individual banks or will individual banks be able to go ahead with a rate easing cycle, or will their hands be forced? Let's say India, for example.
As things stand at the moment, markets are anticipating that other central banks will be able to have a bit more latitude as far as rate cuts. But clearly, as you quite rightly point out, that's sort of predicated on whether or not the tariffs affect other countries in the same way or even more. So you've got to hold that to one side. For instance, if you look at futures rates predictions at the moment, still expecting something in the region of about 100 basis points or so off European rates, which reflects a better inflationary outlook for the Eurozone, if you will, than is the case in the United States. So from that perspective, maybe a little bit more latitude. As far as India is concerned, yes, I do think there's probably more room for rate cuts in India, and that will be supportive of markets going forward.
Jonathan, just to come to the emerging markets in India story, we've talked about the rate cuts possibility, and here domestically a 25 basis point rate cut is being penciled in the April monetary policy. But having said that, what is your view on the equity side of things? India has seen a constant FII outflow. Nothing has really changed there, but we have seen the mood sort of transition in the last few sessions. Do you think emerging markets like India are going to come back in the spotlight as the Trump trade, so to speak, fades in the US?
Oh, look, I think it's a moment of time, basically, because, I think when you look at the flavour that we've had in the emerging markets, people have seen that opportunity, but each country is going to be affected different by the tariffs, and that's a blanket across everywhere. So I really think it depends on how each individual country plays out its retaliation in the tariffs, and to see how that will then sort of translate down into the domestic economy. There's been a lot of movement in equities across the board, and you remember that last time we were on this show, we sort of turned around and said, well, look, I think equity markets themselves are going to go through a corrective phase, and certainly a very highly volatile phase, and I think that's going to continue. And I wouldn't be surprised if equity markets still come under pressure. Some economies will go sink lower than others, and other people will see there's more opportunity in different regions. But in answering your question, I really think it's really up to how the domestic government handles how they're going to retaliate on the tariffs, to see what sort of policy makes sense and how that values down to the equities.
And there's so much that is up in the air. We don't know how things are going to pan out. But with that caveat, Stephen, I just want to ask you to build on that. In the US yesterday, overnight, you had equities cheer, but then they're making a little bit of a comeback after a sell-off. And the question mark is, if money does flow out of that equity market, where does it go, one? And two, if there aren't going to be as many rate cuts this year as was previously anticipated, yields therefore remain still relatively attractive. And so will they move into Treasury? And so therefore, will they not leave the shores of the US?
I think what we have seen is certainly other markets beginning to take up the slack that the US has given up as a result of concerns over rates and so forth. European markets have obviously been performing very strongly during the first part of this year, partly as a result of government policy changes, particularly in Europe, and partly because they were notable laggards. The same has applied to China. So obviously, a lot of money that has been shifting out, some of it coming out of India, admittedly, and going into China as part of that sort of reflation trade that is continuing. But as President Trump has been saying, it's going to be all eyes on April the 2nd and what the detail is of US tariff policy, because as Jonathan has been saying, there are going to be knock-on effects all the way around the world. We're already seeing in some countries in Asia, for example, countries being destabilized by a flood of very cheap Chinese imports. So the knock-on effect there might be that those countries will have to introduce some form of tariffs on imports on their own to adjust for the effects of that.
And that is inflationary. Point taken. Stephen, thanks so much for joining in. And Jonathan as well. You've given us some things to think about this morning. Thanks so much.